Hello everyone, this is Alex Suslov, Head of Capital Markets at A&D Mortgage with our AD Weekly Digest. As always, we're here to shed more light on economic events, mortgages and market forecasts. We had a slight pause with our digest due to holiday season and we're happy to be back with you here today. This past week was relatively stable as far as rates move and events. Market is awaiting for meaningful events next week. We have CPI and FOMC meeting following one another. Both events would provide a better outlook for the following year. Non-KM market remains relatively stable as well. We saw several issuances in the past months and those issuances had pretty good levels. What this means to the mortgage society, liquidity is out there for non-KM loans, which means rates should remain favorable. We're working on improving our jumbo program at A&D Mortgage. We're introducing ARM loans on our prime jumbo. This would result in almost a 50 basis points improvement in the rate on the jumbo program. With this being said, turning it to Billy to get more insight on the expectations for CPI and FOMC meeting next week. Hello Billy, good to see you here after a slight break. What's going on?
Hello Alex, all good at my end. It's good to be back doing the digest. I usually begin by talking about what has happened since the previous digest, but since that was back on November 21st, there's a bit too much to go over. Just prior to that last digest, we had gotten a very friendly CPI report, the November CPI report. And that sparked a rally, and that rally persisted through last week despite a much stronger than expected jobs report out of the BLS. We may have seen it come to a temporary end. That remains to be seen. Tomorrow we get the December CPI number. Wednesday, of course, we get the last rate hike of the year and the comments that go with it. So I guess we'll see what we'll see. The minutes of the last FOMC meeting made it abundantly clear that the Fed is not done raising rates. And they also said that a pivot to lowering rates has not even been discussed. But they did mention an easing of the pace of the rate hikes, which I think means we'll probably see a 50 basis point hike on Wednesday, and maybe just 25 come February 1st. That last one, though, has one more jobs report and two more inflation reports to get through, so remains to be seen. During the last digest, I sat right here and said we can probably expect to see a 50 basis point hike in December and then 25 to 50 the first week of February. So has anything really changed? With regards to the Fed, I'd say no, but the markets have improved. What had been a 65 basis point rally on the 21st of November is extended now to more than 90. There's been enough pattern development for me to now say that the rally looks impulsive. And what that tells me is that there should be a pullback at some point, followed by a secondary rally. So this first rally's taken 6 weeks. I could now see this going on for several months, and I always had felt like there'd be a 3 to 5 month rally before the final yield crests were made, so this is starting to fit right into the patterns. I did suggest during the last digest that with Treasuries already 100 basis points below where Fed funds were likely to be in February, and now that's 150, that expecting strong rallies might be a bridge too far. But having done a little more homework, I saw that in 1981, which is when the high yields were made and the yield spreads were at their most inverted, the 10 to 30 year and the 30 to 10 to 30 to 5 and the 10 to 5 yield spreads were all about 70 basis points. But what I did see was back then Fed funds at one point traded 400 basis points above the 5 and 10 year yields. So that makes for a historical precedent that would allow for larger rallies from here. And the one last thing I'll say is that at that last digest I mentioned that if I were looking at charts that were anything other than Treasury charts, I would have expected far better recoveries. So what that tells me is I should stick with what I know best, which is follow my charts and see where they take me. We'll get past the CPI report and Fed minutes. Currently, 5s and 10s are trading around 375 and 355. I think we'll see them both in the 4% area before secondary rallies begin. Remains to be seen, however, whether the first rallies have ended. We've already recovered nearly 50% of the 200 basis point breaks out of August 4th, and that's reason to be wary of and to respect any failures. But I still think there'll be secondary rallies. Back to you, Alex.
Billy, appreciate the overview. I want to remind our audience to stay on top of their pipelines this week with the potential volatility followed by FOMC meeting and CPI numbers. Make sure to follow us on YouTube channel, like this video and subscribe to Billy's daily market newsletters to stay on top of the capital market events. Thanks everyone, it was Suslov, Head of Capital Markets at A&D Mortgage. Stay tuned.